Hello and welcome to our quarterly investment playbook tagged Stagflation and Recession risk strategy for navigating the new normal. This meeting is organized by AfriInvest Asset Management Limited, a subsidiary of AfriInvest West Africa Limited. My name is Victoria Injimanze, and I will be your host for today. The aim of this meeting is to keep our esteemed clients updated on the most recent economic updates globally, while trying to provide a crystal ball view into our outlook for the third quarter and actually for the rest of the year. 6 months ago, when the whole thing started, the economic landscape was marked differently from what we have seen today. The US and Eurozone were projected to grow at twice, the potential rate that we have in 2022, and emerging markets were also projected to grow at similar pace. But fast forward to the end of Q2 2022, and it's an unmitigated disaster so far for the financial market. The world has been hit so far by a 1-2 punch, which is both inflation and lower or slower economic growth. So today, the panelists who are, esteemed team members will be taking us through the outlook for 2020, for Q3, and what happened in the market for the second quarter of the year. Please note that the recording would be provided on our YouTube channel, and if you have questions, you can always drop them. Without wasting further time, we'll be calling on Raymond Okpara, who is going to be taking us through the global macro review and outlook for next quarter. Raymond, over to you.
Okay. Thank you, Victoria, for that opening. From the global macro review for the first half of the year, what we're seeing is taking us back a bit. 2 years ago, with 1 million people out of work and central bankers trying to lift out their economies from a pandemic-induced recession, inflation seemed to be an afterthought. I mean, a year later, with unemployment falling and inflation rates rising, many policymakers thought that inflation and this soaring price hikes were transitory. Now the inflation rate we see is higher than it's been since the early 1980s, and we've seen central bankers crawling back and attesting to the fact that their calls were wrong. Okay, particularly speaking to US, what we see is that over the year, inflation has risen. I mean, now it's at 9.1%, as we saw the CPI data released for June, coming in higher than expected for 8.9%. And we've seen that the drivers of this global inflation are not far-fetched. The economy is trying to recover from the COVID-19 ripple effects. We're faced with another issue, being geopolitical tensions, and this has led to soaring prices across economies. And we've seen supply chain bottlenecks come up for most of these geopolitical tensions, as we all know, the major players here being Russia and Ukraine, as they form a huge part of exports, majorly relating to the food and raw material prices. Also, we've seen a demand-supply imbalance. I mean, this is still following from the COVID-19 distortions to economies, as demand has grown rapidly due to policy support from authorities with a lagged supply. Global supply chain, we've seen that there's been some resilience in this space. Coming from 2020, the global growth forecast was -5%. In 2021, it was out of COVID, 2 years out of COVID, we've seen it at 9.8%. But going into 2022, the forecast at the end of the year is 3%. I mean, that's a drastic fall from the 2021 levels. And this is basically on the fact of, on the back of reduced international trades amongst, foreign partners, giving out this supply bottleneck. So seeing, particularly the US, the production capacity has been reduced drastically, and central bank has been trying to support, infrastructural changes, and this is transient across global economies. Aside that, we've seen that at the forefront of international trade is like there's a weak global demand, and we've seen trade alignment across partners among this major country. Yeah. All right, now going on to global tightening, we've seen that the path for the central bankers is in the same direction, starting from the Fed, which has been more aggressive. We've seen the Fed increase rates by 125 bips to 1.5%. And at the end of the year, we expect the interest rate to be at 3.4% to avoid a recession. I mean, it's for the central banks, it's a tough needle to tread as they are trying to increase interest rates substantially, but also not try to hamper the economic growth. Across other economies like the Bank of England, also seeing an aggressive policy, but not as aggressive as the US. Surprisingly, for the ECB, we've seen the ECB leave rates constant, but we expect 25 bips increase in July. Across other economies like Egypt and Nigeria, we've also seen central bankers toe the same path of increasing interest rates with the bid to curb inflation.
Nigeria's macroeconomic landscape is not looking so great, and it has been in rough shape prior to the outbreak of the war in Q1. So it may be completely out of place to say that the war is the major cause of our problem. Rather, we can easily conclude that it has further escalated the vulnerabilities that has affected the economy for a long time. In terms of output, right, we've seen a decent run in Q1, largely driven by numbers from our non-oil sector. However, the famous oil sector has suffered a lot of setbacks, ranging from production shortfalls, oil theft, and inefficient management. And of course, this has kept Nigeria on the back foot in a period whereby oil producers are having the times of their lives. Also, in terms of inflation, a common for in Nigeria, inflation rose to about 18.4% in the month of May, which is the highest level we've seen in the past 24 months. Pressures from rising commodity prices, particularly food and energy commodities, heightened insecurity, and weak infrastructure continue to affect consumers' wallets. We know that Nigeria is one of the poorest countries in the current world as we speak today, with inflation eating almost 20%. We can simply say that if external and domestic conditions remain the same, we're likely to retain that position. In terms of public finance, our public finance position has been in a dire situation as the government continues to scramble to improve their top line numbers. However, expenditure on the other hand has been rising at a very fast pace as subsidy payments bite harder than ever before. With budget deficit expected to sit at 6 trillion in 2022, we expect the government to finance this gap through local financing options as external positions are currently a no-go area, given the high risk premium on emerging market economies. Our foreign trade statistic position improved slightly in Q1, and we expect that the trend is going to be sustained in Q2 2022. We've seen signs in that space as well. Oil earnings were the major driver of export in Q1 2022, as oil prices helped to deliver the first trade surplus we've had since Q3 2019. We expect a similar trend to be sustained, like I mentioned earlier. However, despite the higher oil prices, we've observed that foreign investors' interest still remain relatively low in Nigerian economy. And of course, we know that the reasons are not so far-fetched. We have exchange rate risk, insecurity crisis, election and policy uncertainties, topping the domestic challenges in that space. And on the external front, policy normalization and high emerging market risk premium makes it hard for countries like Nigeria to actually retain and actually attract capital flows. Looking ahead, we are yet to identify any major policy change or reforms that could improve drastically Nigeria's economic situation. Externally, we see further headwinds as the global economy gradually heads into a period of stagflation. In this light, we see further deterioration in the country's fiscal position as revenue challenges are likely to persist. Inflation will remain high in subsequent quarters as structural crises are still there. We still see more swings in the FX market as the CBN continues to rationalize FX supplies amid weak reserve levels. And lastly, borrowing cost is expected to also remain high as we see further tightening across central banks in the world. For the financial market, right, the market has actually recorded significant level of sell-offs in the first and second quarter of the year, as investors, appetite towards risk has fallen to a significant low level. So what we observed is that across asset classes, the major dominant factors affecting the market is the global macroeconomic condition as well as monetary policy direction. For this fixed income space, the sell-off in the market was also sustained in Q2. We saw a similar sentiment in Q1 as traders began to price the impact of high inflation numbers and policy hikes by global systemic banks. In the US, we observed that yield went to about 3.1% on the 10-year bond. So saw a similar pattern in UK, Canada, and France. In the BRICS region, yields also went high, save for China, and we know China has been dishing out some sort of support in terms of monetary policy to support the economy. Lastly, for SSC, we saw that yield rose faster, as macro headlines given for serious repricing in that space. Ghana was the worst performer. Ghana's fiscal position and debt burden given for investors to price, their Eurobond, which is currently yielding above 20%, from as low as 9.1% at the end of 2021. The outlook is actually aimed on how fast and how far countries can manage inflation, and also the magnitude and the frequency of further rate hikes in 2022. For equities, based on what we have on screen here, we can officially call it a bear market for the global equity space, as many global indices have lost over 20% in terms of year-to-date return. This was quite anticipated because we know that equities tend to perform poorly in a time of rising interest rates. The developed markets suffered the most sell-off as sentiments were affected by weaker earnings expectation, supply shocks, rising borrowing costs, and recession worries. Meanwhile, emerging markets also, most of the gains they wrapped up in Q1 were lost in Q2 due to capital flight and, of course, lower appetite in that space. Going forward, we expect that the downside risks are actually limited and the possibility of a moderate recovery is still on the table. In the event that we head into a period of stagflation and recession, stocks may trade lower fundamentally, but the direction of monetary policy may change, and then the market could find some level of joy again. For currencies, right, the currency market also had its fair shares of events in Q2 2022. We saw the USD maintain its dominance, right? And this is largely on the back of policy normalization and higher interest rates in the US. The USD has gained over 8% in this year alone. On the flip side, corresponding currencies in Euro, particularly the Euro itself, has witnessed significant weakness in Q2. And this is largely tied to the unfavorable external positions we have in that space. And that is, connected to the Eastern Europe crisis. We expect, currencies to trade at similar band in H2 2022, given that external conditions remains, somewhat the same. For commodities, we've also seen the market maintain a stable, and decent performance in Q2. We saw a very fantastic performance in H1 due to supply crisis. In H2, it was more about stability. For oil, Brent and WTI remained, slightly above $100 per barrel for the most of the quarter, and the outlook is still expected to remain stable, given the fact that countries are beginning to improve supply gradually, and of course, a lot of countries are actually rationalizing the import of crude oil. Let's quickly move to cryptocurrency. For the cryptocurrency space, officially you can declare it a crypto winter, right? As prices are ridiculously low. This is the lowest level we've seen since as high as 2018 thereabout. And of course, the drivers of this sell-off are largely tied to macro headwinds and also loss of confidence in stable coins, and also failing exchanges, which has also dampened investor sentiment. Also, let's not forget that we don't really have free money again in the market for people to start speculating on risky assets. So the conditions are still likely to remain the same for the most part of H2. For real estate, in 2021, we had analyzed that the real estate market was currently enjoying a bubble, given the fact that there was cheap access to funds and excess liquidity in the system. But in 2022, that rhetoric has actually changed. you can see that real estate investment have started slowing, and this is on the back of higher borrowing cost, higher mortgage cost, and a couple of other cost pressures, pushing the demand for real estate investment slightly lower. For H2 2022, we still think that there are further downward room for prices for real estate and investment, given the fact that the bubble we had in 2021 is still yet to be completely deflated. For the Nigerian fixed income space, we had a bearish outing in Q2, and that was largely anticipated as the activities of the market were largely driven by liquidity dynamics, as well as the disposition of regulatory authorities like CBN and the DMO, right? For the CBN, the major impact it had on the market was the fact that they increased policy rate by 150 basis points, and we saw some market participants pricing increment in fixed income yields. However, the magnitude of pricing we saw were quite minute and not as high as we have anticipated. In terms of the outlook for the year, we still think that given the fact that liquidity dynamics are largely skewed to the downside, right? We still think that it will be difficult for traders to pick up papers easily, and as a result, yields are still likely to trend higher in subsequent quarters. Also, given the fact that we have a huge budget deficit as we speak, and the government has little or no other choice than to tap into the local debt market, we think that that could potentially influence yields in the fixed income market in the second half of the year. For Nigerian equity space, oh wow, that market had a decent outing in Q1 and of course in Q2, right? And the performance of that market does not necessarily tell or does not necessarily capture the macroeconomic constraints that the Nigerian economy is currently facing. And that market was the second best performing market across the globe, reporting over 20% as at the end of Q2. And of course, the major drivers of the market were strong bellwether stocks like MTN, Ethel, Seplat, Dangsem, and a couple others. So we still think that going forward, the market is still going to remain in a favorable position, and that the only downside risk we see to the market is the current political crisis, which may dampen investor confidence in Nigeria, and also this high-flying inflation that is likely going to affect the profitability of stocks on the exchange. So that will be the end of my presentation. Thank you very much for listening.
Thank you so much, Babajide. Insightful presentation as always. Please remember that you can use the Q&A box to ask your questions, and we'll take all questions at the end of this presentation. So joining me for the next part of this presentation will be Temitope Omosi, who will be taking us through the stagflation and recession risk global divergence. Even after hearing all of these talks from Babajide on how the bears are in the market for most parts of the market, that's the developed market, while we here at home have seen a bullish run, especially for our equities market. What is the stake for us? Temitope, over to you.
All right, thank you so much, Victoria. I'm really delighted to have this conversation around stagflation and recession risk, because this has been a major concern for investors, because these concepts are quite critical and important at this particular time. And I know that by the end of this presentation, we would have been able to successfully shape on our audience thoughts in terms of what recessions are, and what recession is, and what stagflation is, and which would prevail in the US, Europe, and other regions. So I'll be starting off by drawing a line between a recession and stagflation. So for recession is typically a period of economic contraction, but in economics is defined as as a period of 2 consecutive quarters of negative growth. Although theoretically we believe that a recession is actually typified by a deflation, that is when inflation rate is negative, and we've seen series of that in recent times, particularly in 2021. We saw that Japan Switzerland, in fact, China and Sweden, a number of countries recorded negative, price growth. So that is a typical, characteristic of a recession. But in this dispensation of great inflation, when, increase in prices now, the order of it has taken a toll on a number of countries. So you will observe that the scale we have here, what will lead to the current recession is going to be as a result of, the inflation and great inflation. And for the stagflation part, yes, a number of countries will also go, through this period of, slow growth. So what typifies a stagflation is slow growth plus high inflation and high unemployment. And if you look at the scale for stagflation, you will observe that the pressure will be coming from high inflation and high unemployment. But the condition is that the line is that there won't be a negative growth for stagflation, while for recession, it will be typified by 2 consecutive quarters of negative growth. So looking at the US, the apprehension about economic recession has really heightened significantly, and the reasons are quite clear. For instance, if you look at the yield curve, the US Treasury yield curve from January, March, and June of this year, you observe that it has increased, and even across this period of increase, there's a level of curve inversion of the yield curve. For instance, look at the 4-year yield on 4-year instrument was about 3.4%, in June, and this the 10-year yield was about 3.2%. It's actually showing what contradicts finance term. In finance, it's believed that the longer the instrument, the higher the interest rate. But when investors are apprehensive, the shorter instrument tends to have higher interest rates. So these are what is actually playing out, and is pointing to the fact that there's going to be a recession. But truth be told, there's no consensus as to the period or the pace or the timing of a recession after yield curve inversion. In fact, the most popular argument around yield curve inversion is that it has to be between, say, 3 months instrument and 10-year, not actually the 4-year and 10-year. So if you look at the Purchasing Managers Index as well, you observe a deceleration in trend. For Purchasing Managers Index, it measures what purchasing managers are thinking, their sentiment about the economy, and it's quite clear that it has started decelerating. But we all know that PMI, when it's above the 50 point threshold, is still at the expansionary point, and when it's below that, is at contractionary point. But because this indicator is still above the 50 points, which shows that the fear of a recession may not be in the card for now. And when you go to the US real-time Sam Rule recession indicator, this actually measures the probability of a recession, the likelihood of a recession. You will observe that it spiked significantly in 2020, and the recession actually happened this period. It followed the period of the pandemic, but now it has decelerated significantly. However, you will observe that towards the tail end of June, it has started ticking up a little. So, however, when we move further to confidence in terms of consumer, their confidence, it has started decelerating, and you will see that it's also the same thing as it's getting closer to the level of 2020. So by and large, there are lots of conflicting indicators around the likelihood for a recession in the US, from these leading indicators to some even coincident indicators like unemployment numbers still very strong, labor force participation rates. So all of those are quite strong. So moving on to what top institutions are thinking about a recession, because I know that a number of us want to answer the question of when a recession would happen in the US. As these authorities or those leading companies are as confused as many of us, because they are not even precise as to when a recession will happen in the US. For instance, the Citibank and Morgan Stanley are thinking that there could be a recession within the next 1 year, and the probability is about 50%, while for Deutsche Bank and Goldman Sachs, they are looking at a recession happening in the US within the next 2 years, and the probability is 50%. So one could conclude that no one is actually sure as to the timing and the pace of recession in the US. But I think what is even more interesting is the fact that the US policymakers have learned a lot in terms of dealing with, an economic downturn. If you look at the learning curve we have here, it actually shows months of recovery after a major economic recession, started. You will observe from 1930s, even up to the most recent economic recession of 2020, the months of recovery, have continued to decline. So you could even infer from this that if there's going to be a recession in the US, policy authorities are ready, to tackle it as early as possible. It's quite clear that this would really happen anywhere. Once you know that there's an event will happen, you would have already planned for it. The US economy, like Babajide has explained to us, the market is already looking at a negative, sentiment. In fact, the market is already pricing the recession. That's why we saw significant drawdown in the market. So if there's going to be a recession, there could be much of the stimulus that will even take market upward. So moving on to Europe, we see a deeper systematic risk in Europe. And the reason is because, we look at Europe exports, importation of oil from Russia compared to the United States. United States import about 8% of oil from Russia compared to the total importation of oil to the country. But if you look at these top economies in Europe, right? In fact, in the EU, you will observe that they import a lot compared, to the US. This has actually increased their susceptibility. How these countries respond to vulnerabilities, to shocks, and a number of other, exigencies. So it's quite even evidence from the inflation numbers. Before the most recent number we saw, for the US in terms of inflation that Raymond reported, which has increased to, about 9.1%, you will observe that the US inflation has consistently stayed above others. But it seems because of the fact that, the country is able to weather some of this storm, it seems there's a bit of, respite, and going forward shows that once, deflationary pressure or deflationary trends start to set in, the US will enjoy a level of respite compared to, Europe. So we think that there's a deeper, systematic risk concern in Europe. So moving on to the emerging markets, right? We believe that they are not immune at all. And in fact, currently, or what we've seen so far in the first 6 months this year, we've seen significant, spillover effects of what is happening globally. So from the real sector, we still believe that, economic slowdown could become the order of the day for a number of countries. We've seen increase in inflation, from Ghana to Egypt, even Nigeria. We've seen record high inflation in Nigeria, over 18%, Egypt close to 30%, and Ghana close to 30%, and Egypt. So all of these countries are already grappling with the spillover effect of the stagflation and recession. For financial markets as well, we have seen a lot of pressure, and this pressure will continue going forward. Except for a number of countries, we know that the equities market will remain so downbeating, for the rest of the year. And when you look at in terms of interest rate as well, we know that local borrowing will continue to slow down, and because government will struggle with high interest rate, and government that are hell-bent or they are hamstrung to borrow locally would have to struggle with high debt service. And if you take it to the Eurobond market, currently yields are significantly high, which means pricing of new debts. Pricing of new debt for Nigeria, we're looking at over 13%, Ghana over 20%. So if these countries are coming into the Eurobond market, they are to issue at this price level. It's going to take a toll, on their fiscal or debt sustainability conditions. So they may want to stay clear of this market for now because of this, high interest rate, and this may continue, going forward. So we all know that, looking at stagflation, recession, inflation, we believe that, it's not just everywhere, because a number of countries are outliers, and some of these countries are China, Japan, Switzerland, Denmark. We have a number of others. We have, we have Russia as well. So for China, we've seen significant, policy support by the government, and that has kept the economy a little bit afloat. As a matter of fact, I mentioned that, in 2021, the economy was just struggling with a level of deflation, that is negative, inflation rates before inflation started picking up to currently around between 2.2% to 2.5%. So they are not threat of inflation, and the government still has a level of room to move policy rates even in the accommodative band. For Japan, we've seen that this country had grappled with a prolonged period of slow economic growth, low inflation, in fact deflation as well. But now that inflation is now inching up to about 2.1%, so government is deliberately adopting what is called the yield control curve. So the government is deliberately putting a lid on interest rates so as not to respond to the current rising inflation rate in a bid to stimulate growth. So that will keep the country afloat despite what is happening globally. And we've also seen for Denmark, Switzerland, where government is supporting the economy, and outlook for economic growth is quite applaudable and is plausible. So in the midst of all this, the question that comes to mind is, which is going to happen in the US? What are we going to see in Europe and other regions? So for the US, it's quite clear that, it's going to be mostly stagflation. And we said stagflation from the outset has to do with stagnation, that is when economic growth is quite slow and is typified by level of inflation. But for Europe, we are likely going to see a recession, but this kind of recession is redefined. It won't have the characteristics of a deflation, because it's not. In fact, we think at some point, Monetary Policy Authority will begin to change their long-term view of inflation beyond the 2%, because that is looking like it's off the radar for now. So we want to put all this together, by just asking this question. We look at how likely a recession is across this, this region, the Europe, the US, emerging markets, and the world, based on what we've discussed earlier in terms of, the susceptibility of Europe to what is happening between Russia and Ukraine. And it has actually created a systematic risk. Even if there's going to be a level of, tranquility in that space, the country response, we observe that ECB did not respond as fast to inflation as the Bank of England and the Fed. So that has increased the this region's susceptibility. We think that that a recession is most likely in this region compared to the US, emerging markets, and the world. And in terms of the pace of recovery, we mentioned earlier that the learning curve has significantly improved. We think that if there's going to be a major slowdown in economy or a recession, that the US, emerging markets, and globally, there will be a faster recovery compared to Europe. And if you look at the impact on the financial market, we know that the impact will be severe for Europe because the Monetary Policy Authority is already behind the curve. We think that yield could go as high as 4% and the market could go down to 30%. Yield is currently around about 2.5% on average, and the European market is just down by about 6%. But for the US market, we think that, initially, at the initial point of the recession, yield could go up. If that's on the condition that if there is followed by inflation. However, once there's a recession and inflation is trending upward, we know already what the central bank would do, that is the Fed. Policy rate will be reduced, and this could change this outlook. However, we know that the market could go down to as low as 20% because currently it's down by about 15%. Emerging market will also respond, yield will go up, and the market will also go lower. So conclusively, we expect in the Europe that we will see a recession, but in the US, stagflation is more likely. Thank you very much.
Thank you very much, Temitope. Very, very, very insightful. We acknowledge your questions. We are seeing them and we are going to respond to them at the end of this presentation. Now, we have heard all of this from all our different speakers, and we have gotten to the crux of the event, because I know everybody on this call wants to know the strategy that we can use to navigate this new normal. And for us, there's no better person to take this than the Chief Investment Officer of AfriInvest West Africa, Robert Omotunde, who will be handling this part of the presentation. Robert, over to you.
Right, thank you very much, Victoria, and thanks to all the speakers, Temitope Babajide and Raymond, who have made my work much easier. I mean, talking through the macros and the development that we're seeing for a recession. And for as much as we expect a recession, I think our thesis this afternoon has proven that this is not a likely occurrence, particularly for the US market. However, we could see a recession in the US. We are not likely to see this happen in Europe. I mean, that we have we could see a recession in Europe, but we are not likely to see this happen. The strategy that we have preached since the beginning of the year, we're talking about stagflation that should be implementing. We had about strategy implementation we've done so far in the year, talking about cautious optimism, market timing, staying liquid, portfolio rotation, and then diversification. In terms of optimism, this quarter has presented a lot of downside risk for so many investors, particularly in the fixed income market and the equities market. We've seen a situation where yields are rising, and the Nigerian curve in the Eurobonds market, we've seen yields rise to as high as 14% levels on the longest end. In Ghana, we've seen it as high as 22-23% on the longest end. And in fact, the US 10-year yield has crossed the 3% levels, moderated and then rise again. So it's been characterized with a lot of volatility that investors need to be cautious about. So that strategic theme point is still very important in managing your portfolio in the quarter. Of course, market timing is too important because, I mean, this period presents opportunity where you see prices at, historic low levels, and then you can take advantage of these low prices, applying most of the strategies, which I'm still going to talk through as we go along. Then staying liquid is important because you need to be able to rotate in and out without encumbrances of liquidity, and that's why it's important to buy into liquid assets. For portfolio rotation, this theme is also still very valid as we look into the second half of the year. More importantly, we are preaching, in addition to what we have said before, that there's an opportunity, like an arbitrage that exists right now. Looking at some curves like the Nigerian curve, for example. Take, for instance, you see on the longest end in the local market, you're seeing yields as high as 13%. I mean, we just recently saw the yields going closer to about 13.7 at the last auction that was held. But if you look at what is possible in the Eurobonds market, you can get about the same maturity at as high as 14.5%, with significant discount price, at against the local market that presents price almost at par. So this is an opportunity that we believe that investors could take advantage of, which then speaks to our portfolio rotation theme that we preached at the beginning of the year. Of course, for diversification, we are still very active on that because if you're going to get the return expectation, then you need to be a bit diversified. So that leads me to the next point, which is our allocation for the universe of an ideal portfolio that we think you should be playing in 2022. We've done a bit of adjustment to what we expect, given some of the happenings that we have seen in the second quarter of the year. Of course, we started from the first quarter of the year. So we've increased our allocation to bonds to as high as 50%. The reason is because asset prices are much lower right now, particularly in the Eurobonds market and of course the US Treasury market. Now, the reason why we've done this allocation is because prices are very cheap. In fact, in some instances, you see them lower than the peak at the pandemic level when prices plummeted. That's the situation that we're seeing at this time. So if you look at our asset classes for bonds, equities, commodities, and money markets, we've done some specific adjustments. So if I may just talk through this very briefly, we've done a revised upward adjustment to the bonds from 30% to 50%. For equities, we've adjusted downward to 10% from 20%. And of course, commodities and money market have also been adjusted downwards from 10% to 5% apiece. It's because we believe that you can take advantage of the current opportunities that the market presents. For the fixed income strategy for 2022, we have preached seeking stability ahead of volatility. And we think this is still very critical as we look into the local and the foreign markets, both for Eurobonds and US Treasury and other developed markets. Again, we are still much skewed towards sovereign, although we believe that corporates will present less volatility. Even though the last episodes of drawdown have shown that no instrument is actually very immune, whether it is sovereign or corporate. But again, it's still much more optimal to have a mix between sovereign and corporate for some sort of stability. On the short end, we are still long the longer end of the short end curve, particularly talking about CPs, and other short-term money market securities that long short and short long. And what we meant by this was that the market was going to present a lot of opportunities for shorting, which is still what is happening. This has happened since the beginning of the year. Because of the volatility, you see market drawdowns, markets rises, and then you see a fall again. That presents a lot of opportunity to short. So we called it long short, meaning our normal trade for this particular year, given the volatility, will be to short when the opportunities present themselves, right? But in terms of a long position, because we noticed we've observed that the market will suffer a lot of drawbacks. So I mean, taking a long position is not something that may necessarily give you a good return in the year, except of course you're holding your assets to maturity. So, and that's why we have that short long and long short strategy. So in terms of how you can take advantage of this, we have direct purchases that you can do in the Eurobonds market, in the US Treasury market. If you speak to us, of course, we can help you achieve this with a minimum of 200,000. You are able to, do that. Moving on, if you look at the local markets, I'm speaking specifically to Nigerian bonds market. We preached buying the yield at the beginning of the year and neglecting market correction. We have seen MPR moved to 13% by 150 basis points. It was increased, but we haven't seen a major impact in the secondary market. But recently, we also saw that the GMO also moved slightly in terms of rate. Perhaps this will then begin to impact on the market. But again, it has not neglected or negated our earlier strategy, which we think will work for your local bonds market. Just buy for the yield. And even if yields rise, it gives opportunity to buy even much lower. So we think that you can play this strategy by direct purchases. It could be through your savings bond or a ticket size bonds that you can do. Of course, if you are one of our clients or you're willing to be our clients, you can speak to us and we can guide you on how you get this done. Another way to invest in this strategy is to buy our NIDF, which is a mutual fund regulated by the Nigerian, the Securities and Exchange Commission. In this SSA market, if you look at our model portfolio, we returned about 21.9% to the negative. And of course, it's because of the drawdowns that we've seen. So assets are ridiculously cheap right now. And this is the time that investors can take advantage of them. The prices we're seeing right now were last seen at the peak of the pandemic when market was experiencing this trough. And what happened before the end of that year was that market peaked again, and prices that were selling as deep discount even went to trade as high as trading at premium. That opportunity is presenting itself right now, and we think that investors can take advantage of it. You can take advantage of it by buying into our AfriInvest Dollar Fund, which is a mutual fund that allows you to buy in as cheap as $1,000. You can do direct purchases of Eurobond, and of course, you can also invest in our private portfolio, which is called the AfriInvest Income Portfolio. And then looking at the money market space, we're a bit conservative on this because yields are not as fantastic, especially at the local market. One way to buy into it, by the way, is to buy into our Plutus fund or our AfriInvest Income Portfolio in Naira. And of course, you can also do your direct purchases through our brokerage subsidiaries. Then the equities market strategy for 2022, we are committed to what we have preached at the beginning of the year, which is that we leg into cheap stocks. We invest in cyclical sectors, and we focus on growth and value stocks. For the Nigerian market, we've enjoyed a bit of rally at the beginning of the year. First half, we benefited from that rally. We think that the rest of the year may be marred with a lot of caution, and as a result of that, you're likely going to see some, sort of stability or some drawdowns. But at best, we think that the market may be a bit just defensive, but we may not see significant return. If you look at the specifics for our developed market, what we think is that the US equities market may still present a mild bullish performance given the drawdowns that it has suffered in the first half of the year. And if you look at our model portfolio for this particular peak in the developed market, US specific, you see that it returned negative 17.5% in the quarter, which then present opportunity to buy even at a much more lower price. If you go to the Nigerian market, our selected portfolio returned 2% for the quarter. We think that this portfolio at best will be defensive as we go into the second half of the year and retaining the gains that made so far in the year. One way to buy into this equity strategy is to do direct purchases and do that through our brokerage subsidiary, of course. Then AfriInvest Equity Fund is an equity portfolio that can help you achieve your objective. On the alternative, we are still also committed to the strategy we preached at the beginning of the year, which is that we are risk conscious, even though we know that alternatives present opportunity to hedge against inflation. But our shorter investment gestation strategy is what we are still implementing. So if I specifically speak to that, on the real estate, we saw drawdowns happening in the second quarter of the year. We think that presents opportunity in some sort. From the local market, one way we play this is through our specific portfolio, the RN and the AIP Naira. And finally, I speak to the commodities. We still preaching caution, but we know that value exists. Only that investors will be able to identify this and play it much more strategically. So I think that brings us to the end of the presentation. I think we'll take your questions, but I think generally speaking, you will agree with me that we seem to have done justice to the stagflation and recession risk, which was the major theme or topic that we chose to focus on in this quarter, and to see how investors can take advantage of the different strategies which we have preached in the beginning of the year, which we then modified for investors to be able to return something fantastic on their respective portfolio. So we'll take your questions right now. Thank you very much for listening.
All right, thank you very much, Robert, for that. That was our Chief Investment Officer of AfriInvest Asset Management Limited. Yes, we can see that our Q&A box is piled up, and we are ready to answer all your questions. So without wasting time, we are going to go straight into the questions. And this is a question from Joseph Olaoluwa. Nigeria just launched the NNPC Limited. Most of the players have stated that this new company would deliver oil gains for Nigeria. With a country that has no refining working, oil theft, fuel subsidy, as well as long petrol queues, what is the future of NNPC Limited? Robert.
So if I may take that, thank you very much, Joseph, for that question. I think we think that it's a positive step to have to be launching that company, NNPC Limited, today. You know, we've always talked about the need for government to run, you know, commercially viable businesses. Oftentimes we say government has no business in business, you know, but where we differ is when government decides to commercialize its business. So NNPC Limited, it's going to come in form of some what we call commercialization, in the sense that government is, you know, still owning the companies or the company, but the company will run as a viable business from a commercial point of view, which means that they will, I mean, the management of the company will run as though it's privately owned and therefore profit making, basically. So, you know, when you have profit making as your target for running a business, the tendency is that you are not likely to be saddled or weighed down by some of the inefficiencies that we see in government. So I want to believe that this company will be left to run as a commercial, you know, entity that it is right now, even though we know that the ownership is still likely skewed to the federal government. But the fact that it will think as a private business, you know, you would think that we believe that there are so many things that they will be able to, you know, think through. In terms of how it Nigeria, I think the country is a bit lucky that I think there is a private sector initiative that has already invested in that. I'm talking about the Dangote refinery, which we expect should come on stream, I mean, in no time. You know, that will at least show to a very large extent the, you know, the competitive market pricing for petroleum products. It's not impossible that the NNPC will also toe that line, you know, in revamping some of the refineries that they inherited. I mean, the new company inherited, and they run them more commercially. But again, I mean, until full operation starts, we may not be able to give a full view as to how we think this will run. But from where we sit right now, we think that the idea behind having an NNPC Limited is to have it commercialized, so that all of the issues that has been dealt with since independence and, you know, since the 1970s can be addressed, and the company can run much more viably. Thank you.
All right, thank you very much, Robert. I can see a lot of anonymous attendees asking the same question, so I'll just ask that question at once to Temitope. What would be your advice for an infant investor or an intending investor who is looking to invest in both the local and the local market?
All right, thank you, Victoria. Thank you, Victoria, for the question. And okay, so for, you know, a budding investor, you're looking at taking advantage of the local market, you know, because you understand that there's a bit of complexity depending on the asset class you're looking at, from the fixed income to the, you know, to the equity space. You know, for equity, you have to do a lot of analysis, from fundamental to technical analysis. You have to watch the news for headline risk factors. To headline risk factors, you know, all of those are quite important. But because you won't be able to do it as, you know, as a starter, this is why we have, you know, for Afro-Invest, we have mutual funds where, you know, the experts, you know, that manage this fund on your behalf, because they understand the dynamics of the market, they know the happenings, they are able to analyze, you know, things and do all of this for you. So that could give you, you know, the ample time to learn the rope, because the first thing we prioritize, which is the essence of the program that we are doing today, this webinar, is knowledge. The first thing to do before you invest in the market is get knowledge, because we, as much as we prioritize growing our investors' money, we also prioritize, you know, securing, safeguarding it, not losing the money. So what I would say in essence is start with a mutual fund
which, AfroInvest, we have a lot of that across the board. We have, the equities fund, we have the dollar fund that covers the bond market, the Eurobond market, we have the local bond, and we have money market. So all of that will give you ample time to learn. Thank you.
All right, thank you. Talking about mutual fund, lots of questions coming in around how the mutual fund works. So I would want Robert to speak to that, especially the dollar-denominated fixed income investments that we have.
All right, thank you very much. So mutual funds, from the sound of the word, they are like collective investment schemes where investors come together, put their funds together, and then invest in underlying assets that is of interest to them. So typically we have mutual funds that are tracking different asset classes depending on the objective that the fund manager seeks to achieve. Today it's easier to see mutual funds tracking money market instruments. Usually we call it money market fund. As we have it, a typical example of that is AfroInvest Bluetooth fund that is investing in money market instruments. The objective of that fund basically would be to provide, number one, to preserve your capital, and then to provide periodic return to investors. And that's why the way money market funds are designed, every 3 months, or 6 months, or 1 month, as the case may be, you return back the return to the investors as some way of dividend, for their investment. So that's for a typical example of a mutual fund. For the dollar fund, the way it works, again, I need to say before I speak to the dollar fund is that because it's a collective investment scheme where different investors put funds together, and then you have fund manager in place, there's a governance around it, the governance that helps to protect the unit holders or the investors in that fund. So that governance comes, in most climes, and in fact in Nigeria as we have it, you have the Securities and Exchange Commission providing that regulatory framework for the governance. So for a typical mutual fund, you will see the fund manager, who will be the person that created the product in itself. You have the trustee, who will help protect the interest of the investors. You have the custodian, who will help to warehouse the assets. You have the registrar, who will help to keep the record of all the unit holders. So the governance around it helps to ensure that investors' interests are well protected. So in the case of a dollar fund, as we have it in Nigeria, mostly we have dollar funds tracking Eurobonds market, mostly the Nigerian sovereign Eurobonds and the Nigerian corporate Eurobonds. So I'll use AfroInvest Dollar Fund as an example. With a minimum of $1,000, given the current exchange rate today, that's about 600,000 naira. You are able to buy a unit of the AfroInvest Dollar Fund. Now, you are a unit holder as much as many other unit holders in the fund. And then when we put funds together, an example is that the minimum ticket size you will be able to purchase in the Eurobonds market is about $200,000, right? So you may not be able to produce that $200,000, hence you are not able to participate. But with the mutual fund, you are then given an opportunity because we have broken them into units as little as $1,000, like I mentioned. So you have 200, unit holders putting together $1,000 each, and then we have enough money to be able to buy a unit, and then we fractionalize it so that they can have their units in the investment. Then the fundamentals of whatever instruments they have purchased is what determines what returns come to them. So you're not losing anything by buying a smaller unit, or by buying a bigger unit. So I think that's the essence of mutual fund. And plus, you have a fund manager and the governance structure around it to help protect your investment. So I hope that answers how mutual funds work. Thank you.
All right, thank you very much, Robert. Thank you everyone for participating and for taking out time out of your very busy schedules to be part of today's webinar. It has been a 1 hour well spent from my side, and I hope it's the same for you. Please note that we have taken We acknowledge all the emails that we see here in the chat box, and we're going to add these emails to our mailing list to get this presentation. And yes, this presentation will be made available, the PDF file of it will be made available to all our esteemed clients. Till we see you again next quarter, do have a lovely rest of the day. Thank you.